This video is going to cover the analysis of a company's financial statements. If you're a stock investor and you're really graduating to being an individual stock investor, you really want to get good at reading the financial statements for a company. The financial statements that are produced quarterly will tell you about the company's performance, their execution. It enables you to grade the management team. It also tells you the history of the company, and it enables you to value the company and see what the company is worth. Reading the financial statements and having the skills to do so, it takes a long time. So as you read financial statements, if you're new to it and it doesn't come out really clear, maybe it's not intuitive to you, you're not alone. I graduated in accounting, really focused in that area. And as I learned accounting, some concepts took a while to learn. Accrual accounting, the difference between the income statement and the statement of free cash flows. It takes a while for it to become intuitive, but I really encourage you to dig in and really get good at it. The reason for it is this is really the window into the company for you to really understand the company and then make the investment in a particular stock. I know I worked really hard for my money, and I really like knowing what's going on with the business before I invest my hard-earned money. I'm sure you feel the same way. You want to make good investments, and improving your skills around reading the financial statements is going to make you a better investor. It's going to help you understand businesses that much better. So in this video, I'm going to cover the analysis of each of the three primary financial statements that I look at, which include the income statement, the balance sheet, and the statement of cash flows. I'm going to look at three different businesses because as you go from industry to industry, the financial statements change a bit, principally because you may have a technology company that provides a subscription. Their financials are going to be different than a manufacturing company that runs factories, has to invest a lot of capital in factories, and they produce a tangible product that has parts and pieces, components, and so forth. So those financials look very different. So I wanted to go through one set in its entirety, just step by step, and then reference two more sets of financials, just so that you could see the differences between industries and how financials might look differently. But at the end of the day, financial statements have to conform to the SEC's requirements and be generally accepted accounting principles that the company uses. So it makes it clear on what's being communicated. It enables us to really understand the business. So let's get into the first set of financials. The first company I'm going to analyze is Adobe. And I wanted to start from scratch, just with a browser, and show you where anybody can get the financial statements for any company. It's very easy. I'm going to go to my search screen and I'm going to put in the symbol for Adobe and type in investor relations. It takes me to the Adobe investor relations page. Within the investor relations portal for Adobe, I'm going to find, and this is typical to any company, different sources or information topics for the company. I'm looking for financials, and I can see that it's going to give me, for the most current fiscal year, the Form 10Q, and that is 10Q for the quarter. At the end of the year, they're going to call it the 10K. And you could also find the financials in a more of a PDF, and it's going to be a little nicely presented, but I'm going to give it to you kind of the old fashioned way, the way that a company has to produce their financials to the market. And within it, the 10Q is going to have table of contents. Wonderful. Let's get started with the income statement. Now, my flow is going to go income statement to balance sheet to statement of cash flows. The reason I do that is that I believe that each year the company is graded based on the income statement. The history of the company is revealed in the balance sheet. The value of the company you can calculate with the statement of free cash flows. So I like starting with how's the business doing in the quarter and for the past year. So looking at the income statement, we can see revenue. Now, I focus on revenue. It's a really important area of the income statement, and it's a really important area for the company because revenue tells us if the company is growing, if it's growing its product lines, if it's growing its customer base, if customers like the product, are they growing around the world, maybe to new markets. All those things, growth is good. It's probably no surprise to any investor that growth companies sell for higher stock prices. And it's really this section of the income statement that tells us how fast are they growing. In this case here, Adobe is going for just the quarter from $4.6 billion in revenue up to 5.1 billion in revenue. So that's a really nice growth rate. I believe the growth rate is about 10%, 11%. Adobe is a pretty mature company. It's been around for a while. So that's a very good growth rate. It shows that the management team's doing a good job growing the company. So we know the company's growing. You may have companies that are losing sales. Now, what's important to see is expand your horizon. Look at 5 years and see if maybe they're having a tough year, or maybe there was a big factor. For example, we had COVID 4 years ago in a business that, like, let's say cruise lines for cruise ships, they had a brutal year, just a horrible year. Nobody could go on their cruises, but now they're doing great. So that big dip in that 1 year wasn't their fault. It just happened to be that we had this worldwide pandemic. So take that into account, that we're seeing the current year performance, the current quarter performance, but expand to many years. That way you have a sense of a perfect case would be if a company's growing over time. They just keep adding to their revenue and keep getting bigger. But if there is kind of a low point, understand it and see if there's a good explanation for it. When we get away from revenue, now we're going to look at cost. And for Adobe, this is a software company. They're not manufacturing anything. They don't need factories and so forth. So their cost is actually really low, which is very attractive. That's why software companies are so valuable. The total cost of revenue is just $590 million, but their revenue is 5.1 billion. So their gross profit is 4.5 billion. That's a great gross profit. I believe it's about 88%. That is awesome. I'll compare this to other businesses and you'll see that this is why software companies are so valuable. It's no big surprise that Microsoft is the most valuable company on the stock market. And this is one of the reasons, their gross profit. After we get this is considered, the gross profit is considered when you sell one more unit of your product or service. This is how much profit you would actually make. Now, as we move down, we're going to have operating expenses. And these operating expenses are not directly related to producing that revenue to the customer. They're just, your administrative expenses, research and development to make your products better overall, or maybe create a new product, a new service, and so forth. Sales and marketing. So these cannot be, aligned with a direct transaction on that top line revenue. So they're put into that category of operating expenses. And the operating expenses for Adobe were 3.6 billion. So after all that, their operating income is about $907 million. Now, what I would put in here is you see that there is a one-time acquisition fee, termination of an acquisition fee. Adobe was trying to acquire a company and it didn't work out. So they had to pay $1 billion termination fee. And that's a one-time event. It's important to see if some of these items are one-time or if they're going to be reoccurring. This isn't going to happen every year. So if that didn't happen, they would have been at around 1.9 billion in operating income, more comparable to last year for the same quarter, which was at 1.5 billion. Now, this is, a bad outcome to an acquisition, but I don't really think that's a big problem for Adobe. It was a bad outcome, but hey, acquiring businesses is something Adobe's done really well. And at the end of the day, it's not that they intended on failing with this acquisition. It just didn't work out. So I'm not going to hold that against them too much, but it's good to explain these big numbers that are happening and make sure we understand, what's going on with the business. Once we get through the operations of the business, there's interest, which is something that companies pay on their debt, and there's investment gains. Now, the reason that these are separated is they're not really in direct, they're not affecting the operations of the business. They're just kind of side things like interest or gains on investments. Then we get to our net income. Net income is down here. And of course, earnings per share. Net income is then divided by the number of shares, and we get to our earnings per share numbers. So that's how we get to earnings per share. We take the income statement, we go through, establish the net profit for a business, and it's divided by the number of shares outstanding. That's the income statement. This is a really good statement, really important statement. And again, I really put a lot of thought into the revenue line. If a business is growing, it shows to me that that business is desirable. Their products are desirable. All those things are important to me. And then from there, I look at the profitability of the company. So we're through with the income statement. Now let's take a look at the balance sheet for Adobe. When we look at the balance sheet is basically almost like the savings account and the whole resume for the company through its entire existence. you're going to see some lines here that are really an accumulation of numbers since the company was founded. So these numbers, I happen to think, is the history of the company. We have three sections to a balance sheet. We have assets, we have liabilities, and equity. And always assets have to equal liabilities and equity. It always has to balance. The sections of assets, we have current assets, which include cash, and I like to really focus on cash and cash equivalents. And the reason for it is, a business, the balance sheet will tell us if a business has a risk of going bankrupt, or if they're going to have really hard times, if they're going to be able to fund their growth, if they can acquire other businesses. How can they borrow money in the form of bonds? If they have a good rating, which is tied to their balance sheet, they'll be able to borrow at lower interest rates. So assets is really important. And I like to look at cash because, typically the most valuable companies, they tend to have a lot of cash because they produce a lot of cash. And that's kind of a signal that, hey, this is a valuable company if they have a lot of cash. If they have very little cash and always struggle to have cash, that is a signal that you may have a company that has risk and maybe isn't as valuable as we would like. So cash and cash equivalents, which includes short-term investments, which could be sold very quickly or they redeem very quickly, for Adobe is close to 6.8 billion, which is a very good cash balance. Other assets in the current assets bucket are like accounts receivable, where customers are expecting to pay us, some property and equipment. And we're getting away from current assets and looking at long-term assets. You're going to see a line for goodwill. Now, goodwill is basically when Adobe acquired other businesses and there was a difference between the book value of that company and what they paid, they book that into goodwill. They say, well, that business is worth more. And really, I believe that they just had to pay a premium or else the stockholders wouldn't have sold them the company. And it has to be booked into a particular account, in this case, to put it into goodwill. So that's just a number that's going to show up. I don't pay a lot of attention to that number. It's not that important to me. I primarily look at cash and I look at debt. Debt's in the liability section of the balance sheet. Debt can kill a company. Debt could be a big problem for companies. So I like to see debt really be managed. In the case of Adobe, they have debt both in the current section of their liabilities as well as their long-term liabilities. And when I add the two, 2.1 plus 1.5, we're up to about 3.6 billion, and they have more cash than they do debt. That's great. I like having debt being less than 3 times EBITDA, and we'll get to EBITDA in a few minutes. That tells me if they're below 3 times EBITDA, that a business can pay all their debt off in less than 3 years. In the case of Adobe, they can pay their debt off immediately. So their balance sheet's really healthy. Other things to cover in long-term liabilities, they might have some lease liabilities on their office space. That isn't that important to me. Then you have stockholders' equity. This isn't that important to me. And the reason for it is that I know how many shares are outstanding. I know the share price and I know the market cap. I really focus on those items rather than kind of getting lost in the stockholders' equity. Stockholders' equity is probably for accounting fans that really want to dig into it, but they don't really help me make a lot of great investments. Again, the things I look at in the balance sheet are the cash level and cash equivalents, the debt level. Those are the two main items I'm looking for in the balance sheet. So a ratio that I use as I make decisions to invest in a business is that I want debt to be less than 3 times EBITDA. And let's go through that calculation together on Adobe. So the debt, we came up with $3.6 billion of debt. Now the EBITDA, which is actually produced in the income statement, is $4.4 billion. So with EBITDA, Adobe could pay off all their debt within 1 year if they didn't want to use their cash. So overall, this is a very low risk balance sheet. They could pay off their debt immediately, but if they didn't want to use their cash, they could just use their EBITDA, which is earnings before interest, depreciation, and taxes. That's what EBITDA stands for. And it really shows that, hey, if a business wanted to pay off their debt and they operated the business, it would create that type of EBITDA and we could pay off debt. Now let's talk about my favorite statement, which is the statement of cash flows. And the statement of cash flows, ever since I started studying accounting, it was always my favorite statement because it just made the most sense to me. If you run a business, or frankly, if you run your household budget, you understand cash. You understand that, hey, I need to have the cash on hand to pay my bills. If I want to go on vacation and I want to pay cash for that vacation, I need the cash on hand and so forth. cash is king. And the statement of cash flows, in my opinion, actually makes the most sense of all three of the statements I just covered. Let's go through it, and I'll point out the things that are important to me as a value stock investor. So the statement of cash flows has three sections. The first section is cash flows from operating activities. The second is cash flows from investing activities. And the third is cash flow from financing activities. And to give you just a quick overview of the sections, the operating activities is the business is being operated. How much cash did it produce? The most valuable businesses in the world produce a lot of cash through operations. So we're going to really focus on that. Investing activities is where the company is investing. They might be buying an investment in bonds. They may be doing certain investments in property and so forth. And the last is financing activities. Maybe they're issuing out stock and they're receiving proceeds from the issuance of stock. And they may be borrowing money and they may be receiving funds from the debt they issued out. So those are the three sections. Now, the reason why cash from operations is the most important is that tells us how valuable the business is. If the business, through operating it, produces a lot of cash, it's almost having a money tree. Money does grow on trees if you buy the right stocks. And this tree is going to yield a lot of fruit, and the fruit is cash. In the case of Adobe, we have a company that is producing over $1 billion each quarter. And in the most recent quarter, they produced $1.1 billion of cash. And remember that $1 billion payment to terminate the acquisition? That's showing up again. See how last year for the same quarter, they were close to $1.7 billion in cash from operations, but it's down quite a bit. And the reason for it is that $1 billion payment. That's not going to happen again. So I would actually think that their normal run rate would have been $2.1 billion in cash from operations for this quarter, but it's not. But I'm going to take that into account as I value the company because I'm not expecting they're going to pay $1 billion every quarter. They just paid it because they had to terminate that acquisition. The other piece that we take away to get to the term free cash flow. Free cash flow is cash from operations minus the investment in plant, property, and equipment, also referred to as capital expense. Now, why does this make sense? Is if you have a company that produces cash, that's great. But do you have to reinvest in the business ongoing? Absolutely. Now, the businesses that don't have to invest a whole lot are more valuable than businesses that have to invest a considerable amount, which is one of the reasons I don't invest in utilities. The utility companies produce cash, then they have to put as much or more into capital expense just to rebuild the power plants they're running or the hydro plants they're running, which to me doesn't make a whole lot of sense. You're kind of making cash and then having to spend the same amount of cash. So that's one example. But in the case of Adobe, their investment in CapEx is really low, just $37 million. Yet they make well over $1 billion of cash from operations. So Adobe has very high free cash flow. And I use free cash flow as one of my principal valuation metrics that I put into my valuation model that I've covered already in another session. And that model, I put an example on the community page. Financial statements are going to have the same format no matter what company you look at. But what's the contents of that in the format are going to be very different. And I wanted to show a few examples away from software. We saw how Adobe financials look, but let's look at a grocery company, which is Kroger. You may be familiar with them. You may have shopped at a Kroger, at a Ralph's, and we're going to go through and take a look at their financials so I can point out a few things. So I go to the table of contents, and the income statement can also be called a statement of operations. And the thing I'll point out is their sales have been growing, which is great, and their cost of those sales is much higher. So their profit is much lower. You see how that's much lower than what we saw in Adobe. Now, the grocery business has been around for a long time, and they actually have to sell a tangible product in most cases. So that's where you have a very difference from industry to industry, which would not surprise you that Adobe is worth a lot more than Kroger. But Kroger is a good business. I invest both in Adobe and I invest in Kroger. But I have a different expectation in Kroger because it's just less profitable. And when you'll see in the statement of cash flows, Kroger does produce free cash flows. But I just wanted to point out that as you look at the financial statements and you go from industry to industry, you'll see that there's differences in the profitability level and the amount of cash that businesses produce. And the third and final example I'll provide is Ford. Ford is a manufacturer of cars, and their financials look different than Adobe and Ralph's. When we look at their income statement, it's going to have revenue, but it's going to have a lot of cost. It costs a lot of money to produce cars, a lot of parts, labor, all kinds of good stuff. So when you look at Ford, you're going to see that their profitability is much leaner and tighter, but they too also provide free cash flow. And I'm also an investor in Ford. More traditional older businesses like Ford and Kroger tend to be mature. You can study their financials, geez, for 30, 40 years. Don't need to. You can just study the last couple of years and really understand that, hey, these businesses have been fairly stable. They tend to pay dividends, and you can see how their cash flows will fund the dividends they pay. So those are three different companies. We expect different levels in the numbers, different profit levels, but the format will be the same. A company has to produce their income statement, their balance sheet, and their statement of cash flows. So investors like us have a window into the company to see how they're operating, see what their history has been, and see how much cash they're producing so we can value those companies, then make a sound decision on our investments. So that concludes my review of financial statements and how I go about reviewing the financial statements. I encourage you to dig in and really get to know the businesses you're thinking of investing in. Or if you're already an investor, make it a habit to review their financials every time they produce them every quarter. Really get to know them so you know what's going on with them. Remember that financials have to be produced with a lot of accuracy. If officers produce financials that are illegitimate, basically if they commit fraud, they're looking at jail time. And that's really a good thing overall because it keeps companies from making up numbers and defrauding investors. They have to follow the principles that are enforced by the SEC, and they have to be audited from a public auditing firm here in the United States that validates that they've looked at the financials and they believe the financials are accurate. So that's why these financial statements are really trustworthy. And for most companies, they really have been a way for investors to have a relationship with them in the form of their financial statements. I hope you found the content I just provided really interesting. I appreciate you watching, and please give me feedback on how I can make these videos better. Thanks for watching.